Hey everyone, welcome back to Corporate Decoder, the place where we decode the often bizarre world of corporate filings. Today we're diving into a Form 8K filed by Target Global Acquisition Corp, and it involves agreements with shareholders that sound like something out of a corporate spy movie, but are actually quite common. We'll see how a company is trying to push a deal by offering what appears to be a sweetener, but maybe it's not as sweet as it sounds. Before we jump in, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Join the discussion. So what's this Form 8K all about? It's basically a current report companies file to announce major events that could be important to investors. Think of it as a corporate breaking news bulletin. This one was filed this month, June 9, 2025. The main point of this filing is that Target Global Acquisition Corp, which is a special purpose acquisition company, also known as a SPAC, wants more time to find a company to merge with. They want to extend the deadline to December 9, 2026. This is called the Extension Amendment Proposal. SPACs are basically blank check companies that raise money with the purpose of merging with a private company to bring it to the stock market faster. Now, here's where it gets interesting. To get this extension approved, they need the approval of their shareholders, but some shareholders might want to get their money back instead of waiting longer. So the company made deals called non-redemption agreements with some of their shareholders. The company, along with something called the sponsor, which is named CIG Management 3 LLC, agreed with some shareholders that they would not take their money back or redeem their shares at the shareholder meeting. In exchange, these shareholders get something extra if the initial business combination, meaning the merger, actually happens. It's like saying, hey, if you stick with us, you'll get a bonus later. What's the bonus? For every share they don't redeem, they get 2.5 extra shares when the merger closes. These are called promote shares. It's like getting 2.5 shares for everyone you hold. The sponsor, CIG Management 3 LLC, is also giving up some of its own shares to make this happen. The sponsor is basically giving away shares equal to the number of promote shares given to those shareholders that didn't redeem their shares. This means that the sponsor will take a hit for this to happen. There are some conditions that would cancel the non-redemption agreements. The agreements end if the shareholders don't approve the extension, if the company decides not to proceed with the extension, if the deal is fulfilled, if the company liquidates, or if the parties agree to terminate the agreement. The company says these agreements aren't really supposed to increase the chances that the extension is approved. Instead, they expect to keep more money in the company's trust account. So it seems their main intention is to have more cash on hand after the shareholder meeting. The company and the sponsor might even make more of these agreements later. If you want to see the exact details, there's a sample of the agreement attached as Exhibit 10.1, which is incorporated by reference. Now let's talk about who's involved in getting shareholders to vote. The company, its directors and executive officers are all considered participants in this process. Information about the company's directors and officers can be found in the proxy statement that was filed earlier this month, June 3, 2025. There's also a disclaimer that this communication isn't an offer to sell or buy any securities. They are saying that this is not a stock sale pitch. The company has filed a proxy statement with the SEC, and you can find it on the SEC's website. The proxy statement contains important information about the extension and related matters. Finally, there's the usual disclaimer about forward-looking statements. These are statements about the future, and they come with a warning that things might not go as planned. The company isn't promising anything. They are warning you that plans may change and that they don't promise to update these statements unless they have to by law. Now let's take a step back and look at the bigger picture. What's really going on here? This SPAC is trying to buy itself more time to find a merger target. They are worried that shareholders will get impatient and redeem their shares, leaving their SPAC with less money to complete a deal. Offering extra shares in exchange for not redeeming is a way to incentivize shareholders to stick around. But it also dilutes the ownership of existing shareholders, including the sponsor, that are not part of the agreement. The sponsor giving away their shares is a big deal and shows they are serious about finding a good acquisition. Whether or not this is a good deal for all shareholders depends on whether the SPAC can find a good merger target in the extended time frame. If they do, everyone could benefit. If they don't, the shareholders who didn't redeem will be stuck with a losing investment, but the sponsor already took a haircut. Alright, that's our breakdown of Target Global Acquisition Corp's latest filing. What's your take on these kind of agreements and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching and see you next time.